There are moments in history when money stops behaving like money, when savings no longer feel secure, when the rules people trusted for decades change quietly, then all at once. Most people believe those moments belong to the past, something their grandparents lived through, something modern governments would never repeat. But history doesn't disappear, it waits. In the early 1930s, the United States faced a financial breakdown unlike anything it had ever experienced. Banks failed by the thousands. Credit evaporated. Unemployment surged. Confidence in institutions collapsed. And beneath it all, a deeper problem surfaced. The monetary system itself could no longer support the promises made upon it. At that time, money was not just paper backed by faith. It was a legal claim on gold. The dollar existed because gold existed. Every banknote represented a fixed quantity of metal held somewhere in the system. That arrangement worked until it didn't. When the system strained under debt, speculation, and panic, gold became the pressure point. And when governments feel pressure, they don't negotiate with pressure. They remove it. In 1933, the United States did something that most people today struggle to imagine. It didn't tax gold. It didn't regulate gold. It didn't discourage gold. It made owning it illegal. Not through a vote of the public, not through a long debate, but through executive authority, during an emergency, justified by crisis. The action wasn't framed as punishment. It was framed as protection. Protection of banks, protection of jobs, protection of the economy itself. And millions of people accepted that explanation, because the alternative was fear, uncertainty, and punishment under law. To understand how this happened, you have to understand what gold represented before it was taken away. Before 1933, gold was not an investment. It wasn't a hedge. It wasn't speculation. It was money. A dollar was defined as a specific weight of gold. If you held paper currency, you held a promise, and that promise could be redeemed. People trusted that promise because it had always been honored. But trust is fragile when systems overextend. The 1920s saw an explosion of leverage. Stock prices climbed faster than real economic output. Credit expanded beyond what incomes could support. Banks lent aggressively. Speculation replaced savings. When markets reversed in late 1929, the financial structure cracked. Loans defaulted. Banks faced losses they could not absorb. Depositors rushed to withdraw funds that no longer existed in full. This wasn't abstract panic, it was physical. Lines outside banks, locked doors. Life savings gone. As confidence vanished, people did what humans have always done in uncertain times. They reached for what felt solid. They demanded gold. That reaction created a fatal problem for the system. Under a gold-backed currency, widespread conversion of paper into metal drains reserves. If enough people do it, the entire structure collapses. The government cannot print its way out. It cannot borrow without limit. It must either restore confidence or remove the constraint. By early 1933, that constraint was gold itself. Franklin Roosevelt entered office during this collapse. Within days, the banking system was frozen. Withdrawals stopped. Exchange halted. Normal economic life paused. The official explanation was stabilization. The underlying reality was control. Soon after, the government issued an order that changed the meaning of ownership in America. Private citizens were instructed to surrender their gold holdings, coins, bars, certificates, to the banking system in exchange for paper currency at a fixed price determined by the government. Refusal was not symbolic disobedience. It was a felony. The penalties were severe enough to make the message clear. Compliance was not optional. This order didn't target criminals or speculators. It targeted ordinary people, farmers, shopkeepers, families who had saved metal over decades. Gold that had been legal for generations became contraband almost overnight. Most people complied, not because they wanted to, because the cost of resisting was too high. What followed next is rarely discussed with precision. After private gold was absorbed into government control, the official value of gold was changed. Not by the market. By law, the price was raised dramatically. This single act transferred purchasing power from citizens to the state without a single new tax being passed. Those who surrendered gold received paper claims at the old value. The government immediately benefited from the new one. The system didn't collapse after this, it expanded. Freed from gold constraints, the government increased spending. Money supply grew. Prices rose. The economy eventually recovered, but on a new foundation, one where citizens no longer had access to the monetary anchor that once limited government action. For decades afterward, Americans were legally prohibited from owning the very asset that had defined money for thousands of years. This wasn't an accident. It wasn't temporary oversight. It was deliberate. Gold competed with paper promises. Gold revealed inflation. Gold imposed discipline. And discipline was exactly what the system could no longer tolerate. This wasn't unique to one country or one era. Throughout the 20th century, governments across the world responded to monetary stress in remarkably similar ways. Restrictions, controls, confiscations, prohibitions, different languages, same logic. When debt grows faster than productivity, when obligations exceed capacity, and when confidence erodes, governments face a choice. They can reduce spending, default, or inflate. Inflation is the quietest option, but inflation requires compliance. People must hold the currency being devalued. They must lack alternatives. Gold has always been the alternative, which is why it becomes inconvenient during crisis. Fast forward to the present, and the system looks different on the surface, but familiar underneath. Currencies are no longer tied to metal. Money is digital. Transactions are electronic. Banking is global. But the core dynamics remain unchanged. Debt has grown beyond historical precedent. Governments run persistent deficits. Central banks intervene continuously. Interest rates fluctuate between suppression and emergency tightening. And confidence, while outwardly stable, rests on belief rather than constraint. The modern system doesn't need to outlaw gold outright. It doesn't need to send agents door to door. It only needs to ensure that alternatives to the official system are inconvenient, monitored, or discouraged. The mechanisms have evolved. Instead of physical seizure, there are reporting rules. Instead of outright bans, there are transaction barriers. Instead of confiscation, there is friction. Money today lives mostly inside institutions, banks, platforms, networks. And when money lives inside systems, systems define what money can do. This creates a new kind of control, quieter, more technical, less visible. When a crisis emerges in such a system, responses don't arrive with proclamations nailed to doors. They arrive through software updates, emergency measures, and regulatory adjustments announced after markets close. Access can be limited. Transfers delayed. Transactions flagged. Nothing is taken, but movement is restricted. Historically, this is how monetary stress resolves itself. The goal is not punishment. The goal is containment. To keep wealth inside channels that can be managed, taxed, inflated, or redirected. And when enough people believe their wealth is secure, because numbers appear on screens, systems gain time. Time to adjust values. Time to change rules. Time to rebalance obligations. The 1930s showed what happens when gold stands outside the system and exposes its weakness. Modern frameworks are designed to prevent that exposure before it becomes uncontrollable. This doesn't require conspiracy. It requires incentives. Governments act to preserve systems. Systems act to preserve themselves. The question is not whether history will repeat exactly. It never does. The question is whether the same pressures will produce structurally similar outcomes. Wealth transfers disguised as stability. Restrictions framed as protection, and compliance achieved through design rather than force. In 1933, people were told surrendering gold would save the economy. Today, people are told trusting institutions will preserve stability. The language changes. The logic remains. And history suggests that when monetary systems reach their limits, those holding only claims are the last to know, and the first to absorb the cost. As the 20th century progressed, governments learned something important from the events of the 1930s. Outright bans and physical confiscation worked, but they were blunt instruments. They generated resistance. They left a paper trail. And they required visible enforcement. Modern financial systems would be built differently. Instead of relying on physical assets that citizens could hold outside institutions, money would increasingly exist as entries on ledgers. At first, those ledgers were paper. Later, they became digital. Eventually, they became centralized, networked, and programmable. This shift didn't happen because of control alone. It happened because digital money is efficient. It moves faster. It scales globally. It reduces friction in trade and finance. But efficiency always comes with a trade-off. When money becomes data, it becomes governable in ways physical assets never were. In a system where wealth exists, mostly inside banks and payment networks, ownership is no longer absolute. It is conditional. Conditional on access, permissions, solvency, and rules that can change under stress. That distinction matters most during crises. In the decades after World War II, governments expanded welfare systems. Military commitments, and public infrastructure. These expansions were funded through a combination of growth, borrowing, and monetary expansion. As long as growth outpaced obligations, the system remained stable. But over time, obligations compounded faster than productivity. Debt became permanent. Deficits normalized. Central banks became active participants in government financing. Interest rates were managed, not discovered. The world moved from constraint to discretion. By the early 21st century, the global financial system had become deeply interconnected. Banks held each other's liabilities. Governments relied on continuous market confidence. Central banks acted as backstops for both. This structure works well in calm periods. It becomes fragile under strain. When instability appears, governments no longer need to seize assets directly. They can influence outcomes by controlling flows. One example is taxation. Gold and other tangible assets are not taxed like productive investments. They are classified differently. In many jurisdictions, they face higher capital gains rates, additional reporting requirements, and stricter transaction scrutiny. These policies are rarely framed as discouragement. They are framed as fairness, transparency, or anti-evasion measures. But the effect is cumulative. Higher taxes reduce incentive. Reporting increases visibility. Compliance costs add friction. Over time, fewer people choose to hold assets that fall outside the dominant financial system. Another mechanism is regulation of intermediaries. Most people do not buy or sell assets directly with one another. They use brokers, dealers, exchanges, and platforms. Regulating these intermediaries effectively regulates access. Licensing requirements can change. Transaction thresholds can be lowered. Approval processes can be delayed. No asset is banned. But participation becomes narrower. Banking policy plays a similar role. In the past, if a bank failed, depositors lost access to their money because the bank was insolvent. Today, the framework is more complex. In many countries, deposit insurance exists up to a limit. Beyond that limit, depositors are treated not as customers, but as unsecured creditors. This distinction became widely known after financial crises in the early 2010s, when depositors in failing institutions were required to absorb losses as part of resolution efforts. This approach was presented as stability policy. It was designed to prevent taxpayer bailouts and protect the broader system. But it revealed something critical. Money held in banks is not fully owned in the way people assume. Under stress, access and value can change. When funds are trapped during a crisis, options narrow. Conversions stop. Withdrawals slow. Transfers require approval. Timing becomes everything. If a system enters distress over a weekend, the rules can change before markets open on Monday. This is not speculation. It is standard crisis management doctrine. Central banks and regulators plan for scenarios where rapid action is required to prevent cascading failure. Speed matters more than debate. And speed requires pre-authorized tools. Among the most discussed tools today is the concept of central bank digital currencies. A digital currency issued directly by a central authority is often described as a modernization of money. Faster payments, lower costs, greater inclusion. Those benefits are real. But so are the implications. When money exists as a direct liability of a central bank, every unit can carry conditions. Not overt restrictions in normal times, but capabilities. Capabilities that may never be used. Until they are. Transaction approval can be automated. Limits can be imposed instantly. Rules can change universally. Again, this is not unique to any one country. Monetary authorities across the world openly discuss programmability as a feature, not a flaw. From a policy perspective, it allows targeted stimulus, negative interest rates, and rapid enforcement of sanctions or controls. From a citizen perspective, it represents a fundamental change in how money behaves. Cash is bearer property. Digital currency is permissioned. The difference only matters when permissions are adjusted. Capital controls operate on the same principle. During periods of stability, money moves freely across borders. Investments flow. Assets are bought and sold without restriction. But when a currency comes under pressure, governments often intervene. They limit foreign exchange. They restrict outbound transfers. They delay conversions. These measures are always described as temporary. They rarely feel temporary to those affected. Historically, capital controls are introduced to stop panic, to prevent reserves from draining, to buy time. But buying time requires immobilizing wealth. Once implemented, controls tend to expand before they contract. Exemptions narrow. Limits decrease. Oversight increases. At no point is ownership revoked. But functionality is reduced. The effect mirrors older forms of confiscation without the visibility. Wealth remains on paper. Purchasing power erodes in practice. Inflation completes the process. When governments face debt burdens that cannot be repaid through growth or taxation alone, inflation becomes the release valve. It reduces the real value of obligations. It shifts costs quietly. Inflation does not require legislation. It requires liquidity. And liquidity flows most easily where alternatives are constrained. In systems where citizens cannot easily exit into independent stores of value, inflation operates with less resistance. This is not accidental. Throughout history, governments have tolerated inflation when the alternative threatened fiscal collapse. What has changed is how inflation is managed, not its role. In earlier eras, inflation followed debasement of coinage or revaluation of metal. Today, it follows balance sheet expansion and credit creation. The mechanism differs. The outcome aligns. Those holding claims denominated in the inflating unit bear the cost. Those holding assets that adjust faster preserve value. But preserving value increasingly requires navigating a landscape of regulation, compliance, and access. This is why historical analogies to gold confiscation matter. Not because the same event will repeat, but because the same pressures demand resolution. When systems overextend, adjustments are unavoidable. The form they take depends on the tools available. In 1933, the tool was executive order and physical surrender. In the modern era, the tools are digital infrastructure, regulatory authority, and centralized settlement systems. They operate quietly. They scale instantly. They face less resistance. Most people do not notice structural change until after it has occurred. In 1933, people noticed when gold ownership became illegal. Today, change arrives incrementally. A rule here, a requirement there, a restriction justified by safety, security, or stability. Each step appears reasonable in isolation. Together, they redefine what money can do. The lesson of history is not that governments are malicious. It is that governments prioritize system survival. When survival conflicts with individual autonomy, the system wins. The people who navigate such periods best are not those who predict dates or events, but those who understand incentives and structure. They recognize that monetary systems do not fail all at once. They are adjusted, modified, and reshaped under pressure. And they understand that the most important changes rarely arrive with sirens. They arrive as policy. When people look back at moments like 1933, the instinct is to see them as extreme responses to extreme times. A different world, governed by different standards, responding to pressures that no longer exist. That interpretation is comforting and incomplete. What matters in history is not the surface details, but the incentives beneath them. Systems behave predictably when placed under predictable stress. The stress that confronted governments in the early 20th century was simple to describe and difficult to solve. Obligations exceeded capacity. Debt constrained action. Confidence weakened. And the monetary framework limited flexibility. Gold, in that system, represented honesty. It revealed imbalance. It enforced consequences. So it had to be sidelined. The same dynamic appears whenever a monetary system reaches its limits. Not because of ideology, but because of arithmetic. Debt compounds. Interest accumulates. Growth slows. At a certain point, promises made in nominal terms can no longer be honored in real ones. Governments then face choices that are political, not moral. They can default openly, which destroys credibility. They can impose austerity, which risks instability. Or they can change the value of the unit in which obligations are measured. Historically, they choose the third option. That choice does not require villains. It requires survival. In the modern era, the mechanisms for adjusting value are more subtle, but also more powerful. Currencies float. Central banks intervene. Markets absorb signals gradually, rather than catastrophically. The system bends instead of snapping. But bending still transfers stress somewhere. It transfers it to savers, to wage earners, to anyone holding assets that cannot reprice quickly. This is why inflation is so often misunderstood. It is not simply rising prices. It is a redistribution process. It shifts value from holders of fixed claims to issuers of those claims. And it works best when alternatives are limited. In 1933, alternatives were removed by law. Today, alternatives are shaped by structure. When wealth exists primarily as digital records inside regulated institutions, exit is no longer binary. It is conditional. You may be able to move funds until limits apply. You may be able to convert assets until rules change. You may be able to hedge until compliance requirements escalate. None of this requires a single dramatic announcement. It unfolds through policy alignment. Financial stability frameworks prioritize systemic continuity. Anti-money laundering standards prioritize traceability. Tax regimes prioritize reporting. Payment infrastructure prioritizes centralization. Each goal is reasonable on its own. Together, they produce a system where deviation becomes costly. In such a system, most people do not feel coerced. They feel managed. And management is far more effective than force. This is why historical confiscations are not relics. They are reference points. They show what happens when monetary truth becomes inconvenient. Gold has always been problematic for paper systems because it does not rely on permission. It does not require confidence in an issuer. It does not respond to policy statements. It simply exists. When people turn toward it en masse, it signals that trust elsewhere is weakening. That signal is uncomfortable for authorities. Not because gold itself is dangerous, but because what it represents is destabilizing. It reveals dilution. It exposes imbalance. It questions sustainability. Throughout history, governments have responded to that signal, not by addressing the underlying imbalance, but by managing the signal. Sometimes by confiscation. Sometimes by restriction. Sometimes by marginalization. The form adapts. The objective persists. This does not mean the future is predetermined. It means it is bounded by incentives. The modern financial system is far larger, faster, and more complex than anything that existed in the 1930s. Its collapse would be global, not national. Its consequences would extend beyond borders. For that reason, interventions will aim to preserve continuity at almost any cost. Emergency measures will be framed as temporary. Restrictions will be described as safeguards. Structural changes will be presented as modernization. Most people will accept them, not because they are unaware, but because the alternatives appear worse. In 1933, people complied because they feared losing everything. In the future, compliance will come because people fear exclusion. The ability to transact, earn, pay, and participate increasingly depends on remaining inside official systems. Stepping outside those systems is not illegal. It is simply inconvenient. And inconvenience scales faster than prohibition. The most important lesson of history is not what governments did. It is what people assumed would never happen. Few believed gold ownership could be outlawed. Few believed banks could close nationwide. Few believed the definition of money could change overnight. Yet all of it occurred, legally, quickly, and with broad compliance. Not because people were foolish, but because trust had been built over time. Trust delayed skepticism until after the fact. That same trust exists today. Trust that deposits are safe. Trust that access will remain. Trust that rules will change gradually. History suggests those assumptions hold, until they don't. And when they fail suddenly. Crises compress time. Decisions that take years, in normal conditions, are made over weekends. Policies debated endlessly, are implemented overnight. Lines that once seemed unthinkable, are crossed quietly. Afterward, explanations follow. In retrospect, actions appear inevitable. The people most affected are rarely those who expected collapse. They are those who believed stability meant permanence. The purpose of understanding past monetary interventions is not to predict specific events or timelines. It is to recognize structure, to understand how systems behave under pressure, to see which assets depend on permission and which do not, to recognize when stability is maintained through confidence rather than constraint. In every major monetary transition, wealth is not destroyed evenly. It is redistributed. Some forms of wealth adjust automatically. Others absorb the shock. The difference is rarely obvious beforehand. That is why history matters. Not as nostalgia. Not as warning theater. But as pattern. In 1933, the official narrative was economic rescue. In reality, it was a redefinition of money. In the future, the language will differ. The justification will evolve. But the underlying question will be the same. Who bears the cost when promises exceed capacity? History answers that question consistently, and it suggests that those who understand how systems respond to stress are better positioned than those who assume continuity is guaranteed. The moment when wealth became illegal was not an anomaly. It was a response. Responses change shape as tools change, but incentives do not. And systems always act on incentives. That is the lesson hidden beneath the events of 1933. Not that gold was taken, but why it was.